But I think this morning at the opening with Richard, we heard how important it is that we need to care about the planet to have a better society. So it's very relevant that we're talking about greener finance here. I'm going to let each of you introduce yourselves. So let me start first with Marlene.
Thank you very much. Thank you so much for hosting this. So my name is Marlene Ngoyi. I'm the CEO of FEDA. FEDA is the Fund for Export Development in Africa. It's a $1 billion investment fund that focuses on all types of investment in Africa, multi-strategy.
Perfect.
Hello, good afternoon, everyone. My name is Rodrigo Tavares. I'm a full professor of sustainable finance, and I'm also the CEO of the Granito Group. The Granito Group is a financial advisory firm with strategy consulting and fundraising services dedicated to the sustainable economy.
Cool. Brandon?
I'm Brendan Wallace. I am the co-founder of Fifth Wall. Fifth Wall is the largest and the most active investor in technology for the real estate industry and the construction industry. We manage $3.2 billion across 9 different funds.
Excellent. So I wanted to start with setting the stage and understand where we are in terms of green finance. So why don't we start with you, Marlene? How is the state of green finance in Africa?
Thank you very much. So everybody knows, I focus on Africa. I have been for the past 15 years. To give you a little bit of, to set the stage, as I mentioned last year, Africa is one of the lowest emitter of carbon, yet it's one of the continents that is the most vulnerable to the shocks that we see related to climate change. Another thing is we also know that climate change is going to cost quite a lot of money. We're going to need a lot of funding to address it. And based on where we are in our economic development, government and the private sectors don't have the financial resources to do that alone. So international collaboration for that, it's key. A third thing that I want to mention, and it's important to keep that in mind when we think about climate change in Africa, is that we have to mix climate change challenges with economic development challenges. We know that Africa has yet to industrialize. We need to do that to provide people with jobs. We know that we're going to need energy in order to do that. And to me, one of the key opportunities is how we do that, mixing both and not sacrificing one or the other.
And where is the majority of investment going towards in this space?
Yes, so I mean, at the moment, quite frankly, when you look at the emission of green bonds, for instance, Africa only represents 1% of it. It's too small. Out of that 1%, there are 3 or 4 countries that have really led the pace: South Africa, Egypt, Morocco, and Mauritius. Most of the time, it's going into energy projects, into water projects, and some of them are going into construction projects as well. But it's too small. There's a need to do a lot more, obviously.
Okay. And Rodrigo, how does that compare to the global stage?
So 7 years ago, first time I came here to the Future Investment Initiative, we were discussing cloud. Last year, you just reminded us, we were discussing crypto. And this year, we have been discussing artificial intelligence. In the world of green finance, it's pretty much the same. Or the world of sustainable finance, pretty much the same. We start by discussing ethical finance, and then we discuss best-in-class investing. And the latest trend is green finance. So when we discuss sustainable finance and green finance, we have this tendency to set bold goals to achieve certain objectives. Sustainable development goals, $6 trillion. Net zero, $9 trillion. But we have to zoom in and to see how this trickles down to the bottom line. So number one, we have to be conscious that green investments, it's a silo, it's thematic, it's a niche. It's fine. For the short term, it's fine. We should pursue that agenda. But as a niche, the numbers are still fairly small. Green bonds for $150 billion. ESG classified funds, $2.3 trillion. The numbers are still small. And the reason why they are still small is because we have to think mid to long term. There are plenty of challenges in this field. We are still building the architecture, the ESG architecture. The architects have been doing their job, the engineers have been doing their job, but the civil workers are still working on it. We have 30 different national taxonomies, we need one. We have plenty of ESG annual reporting frameworks, we need one. We have plenty of ESG classification systems, we need one. So we still need to do some work. And finally, long term, ESG probably will be so normalized and so mainstream and so banalized, they will stop talking about it.
And when you mean long term, when do you envision that happen? Because like from everything that we hear, it should happen today, or it should have started to happen 20 years ago. But you mentioned now this, and it's like long term. So where do you see it?
So the market is managing around $100 trillion. And I believe that it's not totally fair to expect that a section, a portion of this $100 trillion should be diverted to sustainability assets. Sustainable finance is not picking up a chunk of money and channeling it to sustainability-led assets. Sustainable finance is about picking up sustainability and integrating sustainability into asset allocation, asset management, risk management, in order to have a better perspective of our investment strategy, in order to achieve certain sustainability objectives. But the most important thing is bring sustainability into our equation so that traditional finance and sustainable finance, they simply merge.
Cool. And Brendan, maybe with that, can you explain a little bit on what is the impact of the built environment in climate in general and sustainability in general? And if part of what Rodrigo was saying, is it going to be incorporated in the industry as a norm for everything that it's done, or how do you see it evolving?
And I think I'll just add on to what Rodrigo said. There's a challenge in, and I'm just going to focus on the E in ESG. There's a challenge in making the amount of capital that has been mobilized to solve this problem symmetric to the underlying problems across different industries. And I'll just give a very concrete example from where we focus. So you hear a lot about climate funds and climate tech, which is kind of the latest, greatest rebranding of green tech and clean tech, but call it stuff to decarbonize the economy. There's a very large number of funds focused on agriculture and transportation and manufacturing and plastics. But 40% of global CO2 emissions are real estate, residential and commercial. Buildings and homes are responsible for just under half of global CO2 emissions. And there is very, very little capital being allocated to that space. Only about 6% of the venture capital that today falls under the character of green tech or climate tech actually gets allocated to building materials, batteries, EV charging. And so we've had this systemic underfunding. And so the challenge is that it's great that we're seeing so much capital that's being allocated to the space, but is that capital attenuated to where the emissions are coming from in developed economies and developing economies?
And in your space, and especially if it has such a significant impact in the environment, where in those subspaces should it be predominantly allocated? Like, is there a subspace within that built environment?
I wish I had an elegant answer for that, but it's kind of like everything.
Everything.
I mean, the emissions, when we say that 40% number, if you were to break that down, about 30% of that 40% is building the buildings and the homes in the first place, what's called embodied carbon. All the materials, getting the stuff there, all the stuff you throw away, that's embodied carbon. And the other 70% is just operating it, heating it, cooling it, lighting it, running elevators, et cetera, inside the asset. So we actually have to do both. And the challenge is that the retrofitting side of it, 70% of it, is far less sexy. Because it's basically taking old buildings and investing a lot in them to make them more energy efficient. But we need all of that capital flowing to both of those spaces.
And did the pandemic have a significant effect on construction, of course, and where buildings are built? Is that the new way that we're living, maybe not everybody in the office, is it having a positive or a negative impact?
I would say it's kind of neutral, to be honest. I mean, there's now this kind of existential question around office, which is, do we have too much office in the world? Do we have too many office buildings? And maybe so, but we don't have too few buildings. Now, those office buildings might need to become residential buildings or become something else, but that in no way alleviates the imperative to decarbonize them, meaning they need to be carbon neutral assets, whether they're running as an office building or a residential building or a factory. And there's just been structural underfunding of that space.
Yeah. And Marlene, going back to you and back to Africa, it's very different how you can think about the environment in a developed world versus the developing world. What case studies have you seen that have worked in terms of collaborating between the government, the public, and the private sector on having a positive impact?
Thank you very much. I mean, as I always say, Africa is already green. We emit 3%. We have the largest forest. We are green.
Yeah.
What's important is as we develop, because we need to develop, we cannot have a solution where we say, well, you remain in this situation. We can't. So I like what Rodrigo and Brandon said. What we are looking at right now is let's make a difference wherever we can. So that means, I'll give you an example. FEDA has invested in a lot of industrial parks across Africa. And you might say, what does it have to do with the environment? Well, we're trying to industrialize Africa because we realize that before we would take raw material, export it to another part of the world. When Brandon mentioned that we don't talk a lot about the real estate impact on the environment, we don't talk about the cargo movement impact on the environment. And we look at it this way to say we're not going to take raw material, leaves Africa, goes on a cargo that is very polluting, comes back transformed, still in a cargo. We need to change our way of thinking and reduce those value chains. And you start seeing the synergy between economic development and climate, because we're looking at value change in a very different way, saying they need to be shorter. I do believe that technology has a huge part to play. We need to, there's a lot of Africans that are still off-grid. Let's improve the solar technology. Let's improve the storage technology that we have for that. With regards to all the big ideas, I do believe that there's opportunity to have more green bond. I think last year I spoke about the Inga project in DRC that has the capacity to, with hydro, to fuel the entire continent. Let's please have a green bond and let's have private sector, multilateral DFIs and come and invest in it. That would be game-changing. I do believe that there's still a lot to be done on the carbon credit market, a lot of asymmetry of information, different pricing. We don't really know what projects are being invested in. Are they important? Are they impactful? So there's a lot to be done, and I do believe that when it comes to government, they can state policies to say, this is what I can do, this is what I want to do, we're going to be transparent about it, come and invest, and help us leapfrog to have economic development, but that is sustainable.
Yeah, and maybe, Rodrigo, we can go and dig deeper into that. There's a lot of financial instruments that currently exist, but as you say, they're limited and they haven't been deployed that much. Like, what do you think should happen in that space for it to be more investment?
Well, there is a set of steps that I think they are fundamental to create a sustainable economy. Number one, we need to get the macro policies right. And we have been doing a good job. In Europe, we have the European Green Deal, Fit for 55, the EU Regeneration Plan. Here in the Kingdom, we have Vision 2030. We have the US Inflation Reduction Act in the United States. So at the macro level, we are not doing that bad. And then it trickles down to the programs, the metrics, the rationality, the guidelines, the roadmaps. And here we have two organizations that are doing pretty good work. One is the science-based targets, and the second one is the Institutional Investors Group on Climate Change. Both have roadmaps and guidelines on how to move from the big, bold visions into concrete measures. And I have to remind everyone that there was a recent research indicating that 93% of the companies globally are off track to meet their net zero goals. So that means that these policies, metrics, roadmaps, guidelines that have been formulated over the last years, either they are not being followed or there is something off-piste with them. Third, I think we have to distinguish, we have to keep talking about energy transition and energy security. We keep discussing energy transition and we put the focus on energy, we don't put the focus on transition. Energy transition might take 20, 30 or 40 years. The same period of time that it took to build an oil-dependent economy, it took from 30 to 50 years. It will take 30 to 50 years to create a non-oil-dependent global economy. So transition, it's not binary, it's not Menekes, it's not moving from A to Z, it's not a switch. It will take time. And during this time, we have to come to the conclusion that oil is everywhere. It's in this mic, it's in healthcare, it's in agriculture, it's in construction, it's everywhere. It takes time. And for us to build a powerful, modern, new economy, we still have to rely, sadly or not, we still have to rely on existing sources of energy, and oil is sadly one of them.
Yeah. And maybe to speed up that process, because it sounds like it's going to take us a while, how does tech entrepreneurship play a role? And maybe Brendan, from your side, from the investment perspective, what do you see in terms of innovation in the tech world that it's having a positive effect?
I mean, there's a lot.
Yeah,
but I also think it's a great question to contextualize. If, let's just say you were entirely motivated by altruistic reasons, you wanted to have a carbon neutral building, and you didn't care about the economics. You wanted all the best newfangled technology to do so. If you deployed everything that exists today into that asset, you'd get about 50% of the way to operational carbon zero.
Oh, wow.
Meaning there's a structural gap, and that structural gap we can only close with technology. And so there's a challenge because we have both an implementation problem, meaning a lot of buildings are still at 0%, so we want to get them to 50%. But we'll never get to 100% unless we solve I would say a challenge of capital mobilization to the tech to decarbonize with the right incentives. And I think we've seen some amazing public sector moves. So what you saw in the US, what you saw in EU with the Green New Deal, but we're going to have the private sector also begin to invest in that space.
Yeah.
And that's actually what our fund has been trying to do, which is how do we mobilize these private sector actors to invest into the technology that previously was just being invested in by sometimes venture funds and sometimes public grants and subsidies. But I actually think there's a strong case to be made that the private sector should be investing in it.
And that structural gap that you have, just because with the current technology we only get to that 50%, are there startups out there trying to solve those problems, or we actually also need not only to incentivize funds to invest, but even entrepreneurs to go into the space?
We need both, and to some extent those two things are related, meaning the more capital that's in the space, the more brilliant people will come into that space and deploy their talents to it. But this is the role, fundamentally, of venture capital in an economy. It is supposed to fund high-risk, high-technical risk businesses that are oftentimes loss-making until they can achieve commercial viability. That is the role we want venture capital to play in all parts of society. But we just don't have enough of it because the cost, and this is actually another interesting kind of staggering number, the estimated cost, and I don't know this number globally, but just in the United States to decarbonize all commercial buildings and all homes to true carbon zero, if that technology existed, is $18 trillion. Oh,
wow.
Which is a little less than 1 year of US GDP. So if you assume we're going to do that sometime in the next 40 years, that means we're going to spend 1 year of GDP over the next 40 just fixing our homes and buildings. That's a lot of tech that needs to get deployed, but we need venture capital that's the antecedent to that to actually make it viable in the first place.
Absolutely. And when you see what happens in the US and we hear that we have a green Africa, like how does these two regions should collaborate in order to build this sustainable future?
Yeah, I think what's interesting about this climate challenge, the silver lining in all of this, is that it confirms that we're all together. There is not one region that's going to be able to solve this alone. It's interconnected. The environment doesn't care whether the pollution comes from this part of the world and they got industrialized faster and they have a high GDP and now it doesn't matter. It's if we don't solve this alone, together, we're all doomed. So I think to me that's the silver lining. It shows that beyond villages and countries and continents, there's humanity. I do think that everybody has something to bring to the table. So the West would have the IP, the technology, would have the financing. We have, like I said, the forest. We are at the nascent stage of our industrialization. It means that we can leapfrog. We have the sun for solar. We have all of the raw material necessary for electric vehicles. So we're starting to see that everybody has a part to play. The mindset needs to be different. People shouldn't be seeking to protect their own interests, their own value chain, their own progress. This is when we need to start thinking completely differently, do a reset and say, if we fail, we're going to fail all together. And so for me, it's actually really encouraging. It will push us towards a more collaboration, towards more humanity, essentially.
I don't know, Rodrigo, you want to expand on that? You were...
You know, a few months ago was by the border between Morocco and Algeria, right in the midst of the Sahara. So I was spending some time with this young gentleman, age 35 or so, who used to be a nomad. He's no longer a nomad because of climate change, because climate change affected food supplies, and climate change affected social fabric in that particular region. So he was constantly putting the blame on me as a white man from Europe and putting the blame on developed markets. We did not create this, you did. We need to be financially compensated for the damage that you have caused. So there was the constant narrative in that visit. And it has been the constant narrative over the last COPs. So we had an ample discussion on this last year. We're going to be discussing this year for sure. And if the issue is not properly addressed, it will continue. And we'll be discussing this next year. Hopefully not, but probably in Brazil, in COP30, we're going to have the same discussion. So the discussion is how much money is actually available to be deployed in developing nations to compensate and to help them robust their social, economic, and political equipment in order to mitigate climate change. And the figure is $1 trillion. But the whole world has been talking about this $1 trillion, and we always have a bold objective that we need to maximize or fulfill, but we are always surprised or not surprised at the fact that we are no longer able to fulfill that goal. It's the same with the Sustainable Development Goals, the same with net zero, and it's going to be the same with these $1 trillion. So there are alternatives. And the alternatives for these, not replacing the $1 trillion, but the alternatives or the complements, the add-ons to this are let's focus on regional initiatives and let's focus on national initiatives. In terms of regional initiatives, it's not amply discussed, but we have the Saudi and Middle Eastern initiative, for example. It's $2.5 billion that the kingdom decided to allocate here in the kingdom and in the region in order to help the region to go through climate change challenges and to help them. It's a regional effort helping them to be better equipped to mitigate climate change. So we are not discussing this globally, and we should. But there are also national initiatives that we are not discussing globally, and they are part of the solution. They are an important equation. In Brazil, for example, just 3 or 4 days ago, Brazil was the first country worldwide to adopt the new IFRS S1 and S2 reporting standards. In basic terms, Brazil is going to be the first country adopting the global standard to report sustainability. In Chile, just a week ago, Chile was one of the first nations globally to launch an inflation-linked, sustainability-linked bond. It's a very novel instrument. It's very pioneering. We are not doing this in Europe, but we are doing it, or they are doing it in Latin America. And there are plenty of very interesting products. BDG, the financial powerhouse in Latin America, joined forces with Harvest, a gigantic powerhouse in China. They created an ESG label bonds fund for emerging markets. We are not discussing this globally, but they are doing it in emerging markets. So emerging markets, it's not necessarily part of the problem. It's not just a recipient of $1 trillion. There are no victims in emerging markets. They are part of the solution. They have the resources. If they don't have the resources, we need to empower them. We need to give them capabilities in order to mitigate the problems that the planet is generating, climate change.
Yeah. And maybe, Brandon, just to start closing, and I want to leave the space for the audience if they want to ask at least one question, but what could be like a radical thing that we do to have change at a faster pace? Is there something that you would recommend either to your colleagues in the VC space or to policymakers?
Yeah, I mean, I can talk specifically about the space we cover because I think it's kind of a paradigm for other industries. That problem of 40% of CO2 emissions coming from real estate, it's even more challenging when you look at the structure of the industry that has to solve it. So I just said that the private sector is very important in solving this.
No.
Well, the private sector in real estate is a bunch of relatively small companies as a percent of the total real estate industry. So like climate change itself, the industry is struggling with this collective action problem, which is individually, they can't do that much. They can't actually deploy that much. So one of the things we pioneered was a consortium model where all of these corporates together could pool their capital, and collectively we'd have, in our case, $800 million to invest in this problem for the industry. Now, we still don't have enough firms doing it, but I think that is one model that could be applied to other industries, continents, countries, where you're going to have to solve this through some collective action mechanisms. And I think that's true in the public sector and the private sector.
Okay. I'm just going to open if someone wants to make a question. No? So maybe just to close with Rodrigo and Marlene, with a couple of call to actions also to the audience or to regulators, especially since we're sitting here at FII.
So I'm also a sustainable finance professor at a business school in Europe. And we recently conducted a research covering 54 GCC listed companies. And we looked at everything, firm size, firm ownership. We look at the different industries. We look at their ESG scores individually and as a combo. We look at different parameters, around 6,000 or 7,000 observations. It was 1 year of research. And I'm just announcing it here for the first time because it's the first peer-reviewed article covering ESG in this part of the world. There are two conclusions. Conclusion number one, from a statistical and regressional perspective, out of the E, the S, and the G, only the G counts. So when we establish a correlation between more sustainable companies, they lead to better financial performance. It's only the G, sadly or not. If we improve the G component of the companies in this part of the world, automatically their financial performance also increases. And the second thing, it's the only region on the planet, and that's something that we can announce. It's the only region on the planet where the causation, it's also inverse. That means financial performance leads to better ESG standards. So the richer, the higher the stock price of the companies here, the more internal resources they would have to deploy into perfecting their ESG standards. It's the only region where it happens. So whatever way you look at this correlation between sustainability and financial performance, the bottom line is this correlation does exist. This correlation does exist here. This correlation exists in Africa, exists in the United States, it exists in Latin America, in all parts of the world. It depends on different variables, but the strong trend is there is a strong correlation between sustainability and financial performance. So it will be reckless in a way if the goal is to make more money, if the goal is optimize resources, if the goal is to maximize value, if the goal is to increase your stock price, it will be, I would say, irresponsible to disregard the power of sustainability.
That's great. Marlene, just to close?
Yeah, so I think we've spoken about obviously more capital, we've spoken about more technology, we've spoken about better collaboration, but if I had to sum it up, it's more less talk, more action. People have to be sincere about what they claim and make sure that it's aligned with everyone. That's what I would say.
Perfect. Thank you so much for joining me in the panel, and thank you all for listening.
Thank you.